Hello everyone, welcome to part 1 of Technical Analysis Made Easy series. Before we jump to the video, let's see who should follow this series to ensure that you're part of this journey with me. So this video is for you if you have interest in trading markets, and when I'm saying market, it could be stock market, cryptocurrency, commodity or forex. So if you have interest in trading markets but you're clueless about how to predict prices, at what level to enter, at what level to exit, then this video is for you. So at the end of this series, the learning outcome would be how to predict prices and identify the best level to trade. So watch till the end and enjoy your learning. Let's Okay, all right. So before switching to the technical stuff, I'll just give you a quick brief on my background, my profile, so that we can connect better. My name is Ayush. I am working with a chartered accountant firm based in Dubai. I have total 8 years of experience. So I'm a full-time employee, but just out of passion on a part-time basis, I train candidates on topics such as CFA, stock market, technical analysis, financial modeling. And in terms of qualification, I'm a CFA charter holder from CFA Institute. I am qualified CMA from IMA Institute, USA. And also I hold a master diploma in banking and finance from IFBI Institute, India. Okay, now in terms of table of content, so basically I have divided this series into 6 parts. In each video I will cover one topic. So in this video we'll start with introduction to technical analysis, followed by types of chart, support and resistance, price action patterns, candlestick pattern, and then indicators. Okay, let's start with introduction to technical analysis. By the way, guys, I'm not using the slideshow option or else my face will mess up with the text on the slide. So in terms of introduction to technical analysis, since I don't see technical analysis a rocket science, so I will try to explain what technical analysis is using a very simple example. See this picture and imagine you are on a vacation, a solo trip. You're walking around the street and you're very hungry. So what you do is you stop by a food street. Now you see a lot of vendors selling a lot of different stuff. Everything looks very different, very interesting. But the problem is that you're clueless about what they are selling because you're not familiar with the dishes. So how you will decide which food you will try? Now I will give you two options. First option is you go to each vendor, see what they are selling, ask them what ingredient they have used, or maybe taste a bit to figure out if you like the food. The second option is you stand on a corner and see which vendor is attracting the maximum crowd. Once you see the which vendor is attracting the maximum crowd, you can make a conclusion that if you see a lot of people going to one vendor, the vendor must be selling something good. So these are the two options. Now you tell me which option you will choose. Okay, now keeping this option 1 and option 2 in mind, let's go to our technical stuff. So fundamental analysis versus technical analysis. So the option 1, where you go to each vendor, you taste and then you figure out whether you like the food or not, that is fundamental analysis. That is option 1. The second option, where you observe the crowd, which vendor is attracting the maximum crowd, and then you make an assumption that if that vendor is attracting the maximum crowd, then food can be good. So that is technical analysis. Okay, now this option 1, fundamental analysis, if we talk in terms of selecting a stock or choosing which commodity to buy. So in this example I have considered the fundamental analysis of a stock. So for example, when you do your fundamental analysis on a stock, then what you do is you see what the company what the company does, what is its business model, what its past performance, what is its expectation of future. You also do industry analysis. For example, if your company is in IT industry, how IT industry is performing. You also check on economic condition. For example, if a IT company is based in India, or if a IT company is based in US, what is the overall outlook for US, overall outlook for India. So when you do all your analysis and then you decide whether to pick that stock for buy, or if you already have that stock and make a decision to sell, this is called fundamental analysis. So we're going to cover fundamental analysis in a separate video, but in this series, we're going to concentrate on technical analysis. So now you know in simple terms what technical analysis is. So basically, technical analysis is the study of market in terms of what other market participant are buying or selling, and then decide which stock you should go for. So now let's talk on technical analysis. So what happens is, over the over the period of time, uh, on this chart where you see people buying, selling, some patterns are formed, and that patterns, looking at that patterns, you can make a decision whether to buy a stock or sell a stock. I think we have a good example over here. So looking at this price trend, can you see there's a trend? The prices are going up, it's going down, it's going up, it's going down. So if you draw a line over here, you will see that every time the prices are coming to this line, it is bouncing back. Again, the prices is bouncing back from here. If you again draw a line at the top, you will see prices are going down from here. Again, the prices are going down from here. So let's suppose if this trend will continue, what will happen is, if I want to buy, what I will do is, I will wait for this level, okay, this level, and when the prices will come at this level, I will buy from this level, and then when prices will go up, I will sell at this level. Because what will happen is, if I will draw a line over here, the prices will come here and then again will go down. So using technical analysis, I know at what price I have to enter and at what price I have to exit. So this is one example. Okay, let's take a look at assumptions in technical analysis. So there are four assumptions. Market discount everything. The how is more important than why. Price moves in trend and history tend to repeat itself. So the first one, market discount everything, tell us that all known and unknown information is already built in the prices. So just to make you understand in an easy manner, we'll take an example. Let's suppose the financial budget is expected to come out, and if you see the prices are rallying just before the budget, so it suggests that the majority of the people, the majority of the market participant are expecting the financial budget to be good. That is why prices are increasing. Or if prices are falling, it means it is expected to be not so good in terms of its impact to the market. So basically, whatever it is, you the prices, everything, every information, whether it is public information, private information, it will get reflected in the prices. Second assumption is, the how is more important than why. Again, see, all the assumptions are interrelated. So if prices are increasing, a technical analyst doesn't care why the prices are increasing. Prices are increasing or prices are decreasing, it is important. People are buying, more people are buying, prices are increasing, more people are selling, prices are going down, this is important. So why is not important, how, as in the prices are increasing or decreasing, important. The third point and fourth point, I will try to explain you using one example. Prices move in trend and history tend to repeat itself. History tend to repeat itself means that the history will repeat, and because the history will repeat, you will see patterns on the chart. And prices move in trend is the only basically reason a technical analyst know from where to enter or from where to exit. I will try to explain you using one example. So I'll just take one example to make you understand point 3 and point 4. Okay, this is fine. So basically, this is GBP USD pair. Just don't get confused on what this is, but just stay with me. Okay. So basically, I was trading USD GBP for a very long time. So if you see, there's a pattern over here. See, it is not exact as clear as in the example which we have seen, because market is not like that. So basically, this is lower trend because the prices are going down. Now you see the trend. When prices are coming in this area, it is bouncing back, and when it is coming in this area, it is going down. Okay, and see a pattern over here, and you can make a decision. And you see it broke the line, and then it again came down. So we're going to study all of this. Everything has a relevance, everything has a logic behind it. We are going to study if the prices will go beyond the channel or beyond the line, and if it is not bouncing, and if it is breaking, we're going to study each and every aspect. But all I want to tell you here is that prices move in trend, and history tend to repeat itself. Is like you see at this level the prices are going down. Okay, all right. So now we'll just quickly discuss on key takeaways. So technical analysis: visualize the action of market participant in the form of stock chart that we have seen. Patterns are formed within the chart, and these patterns help a trader identify trading opportunities. I have just given you a few examples. The concept of technical analysis can be applied to any asset classes. Again, we have discussed that you can apply technical analysis on stocks, on commodity, on cryptocurrency shares. So this is the end of part 1. Thank you so much for watching, and I will post the second part very soon. So again, thank you so much and happy learning.